January 8, 2014, the Peterson Institute on International Economics held a 1 hour and 17-minute event to release their new book, Fueling Up the Economic Implications of America's Oil and Gas Boom. It's a 5-minute recap of the natural gas highlights. The authors began by laying out last decade's grim energy realities.
Between 2000 and 2008, we saw a run-up in natural gas and crude oil prices. The outlook for U.S. production growth was pretty grim. The outlook for the cost of supply elsewhere in the world was equally grim.
But high natural gas costs led to heavy investment in the industry and a dramatic increase in production.
And the forecast for future U.S. natural gas production has been significantly revised over the past 6 years as production has grown and our understanding of the resource base has changed. And there's some variation, but most groups now expect the growth in natural gas production to continue for another couple of decades. That dramatic growth in natural gas output has led to a sharp decline in natural gas prices and a historically large disconnect between the price of natural gas and the price of crude oil. And that's created a pretty strong commercial incentive to try to drill for oil whenever you can drill for oil rather than drill for natural gas.
Mr. Houser explained the basic layout of his study.
We modeled the economic implications of a conservative scenario and an optimistic scenario, and we compare that to a pre-shale scenario, which is where we keep all of the same assumptions in the modeling framework, but we change the shale gas and the tight oil resource base back to 2007 levels.
Finding one is money saved.
The change in energy prices between our optimistic and our pre-shale scenario is the most significant economic benefit in the modeling. On an annual average, we find a $180 billion reduction in energy costs.
They also found more money for producers, but not necessarily natural gas producers.
U.S. producer revenue is increasing by $60 billion a year on average between 2013 and 2035. Interestingly, though, while U.S. oil producers do a lot better, natural gas producers actually do a lot worse as a result of the shale boom because the increase in volume is not enough to offset the sharp decline in prices. So
increased investment from the oil and gas boom rivals President Obama's stimulus bill.
Second most important economic impact is the increase in investment. GDP could be as much as 2% higher cumulatively relative to the pre-shale scenario. Employment could be 1.7% higher. That is on par with the impact of the Recovery Act between 2009 and 2013, though over a longer period of time.
Trade deficit impacts are mixed.
The most profound change in economic composition is maybe on the international trade side, where in our optimistic scenario, the energy trade deficit as a share of GDP falls from a high of over 3% in 2008 down to 0.4, 0.3% of GDP by 2030. That doesn't necessarily mean the overall U.S. trade deficit is going to fall.
Cheap gas is great for manufacturing, but helps some industries a lot more than others.
Also, there's this disconnect that's emerged between U.S. energy prices and energy prices for our leading trade partners. And indeed, for certain energy-intensive industries, that means a substantial reduction in production costs. So the question then is, for which industries does a potential reduction in their energy costs, measured as a share of shipment value, offset the potential increase in the exchange rate as a result of a declining energy trade deficit, right? As you can see, chemicals, clear winner, right? The reduction in energy costs far outweighs the potential impact of a higher exchange rate, but if you're in computers and electronics or machinery or transportation equipment, you potentially have more to lose from exchange rate appreciation than you do to gain from lower energy costs.
Regarding carbon dioxide emissions,
they have declined more rapidly over the past few years than emissions in the EU, even though the EU has a emissions trading system and a binding 2020 domestic emission reduction commitment.
In the long run, it might not get emissions much lower, but
it changes the economics and potentially the politics of policies aimed at reducing CO2 emissions. It's cheaper to abate emissions. than it was previously.
And those are the natural gas highlights. Don't forget to like, subscribe, visit our webpage, and think about buying the book from the Peterson Institute.